All right, let's take a look at some of the technical strategies as well, and really what our experts are making of the trend in the market. Let's discuss that on Trade Corner. Kunal, let me kickstart with you then. We were talking about this yesterday, and you did say the trend continues to look a little dicey at this point, and a lot of sell calls that you had on your radar yesterday. How's it looking as we head into trade? What would you like to focus on?
Good morning, Abha. So yeah, I think after breaking the key support of 11,800, I think the trend looks a bit dodgy. For the markets, it doesn't look that strong, both in terms of the Nifty levels as well as when you look at the internals, and especially what transpired yesterday, where a lot of the sectors, in fact most of the sectors, closed negative. So even if it was in the case for a high risk or a high beta sectors like the bank Nifty, real estate, metal stocks, etc., even though the low beta ones like the FMCG and IT, so relative defensives as well underperformed yesterday, and I think that's a bit of a concern. When you're breaking the key support levels, you generally expect a bit of a dichotomy in terms of sector performance, but we did not see it yesterday. Now I believe that the bias has to be a bit on the sell side, and which is why I would go with two sells at this hour, two sell recommendations. First one is a sell on Ashok Leyland. That stock has shown renewed signs of weakness yet again. It's closed the gap which was created I think a couple of weeks back around this 85-86 mark, and I believe now the stock should be heading lower. The previous swing low for Ashok Leyland was closer to 80, so I'm sensing that the stock should try and come back or test that levels at least once. So that's a sell. Targets closer to 80, stop loss 85.5. And the second would be a sell on Strides Pharma. I think even that stock showed signs of weakness yesterday in terms of candlestick pattern. It was quite bearish. And looking at the last 3 months of price patterns as well, it was going through a consolidation. But I think after yesterday's mild bit of downside, the stock has confirmed a swing breakdown on the short-term chart. So I'm sensing that this consolidation could give way to a downtrend for Strides Pharma. Hence, recommending a short for a target of 400 and stop us at 420.
Right. Manas, hi, good morning. Where do you believe the market would head, and does it seem like we're headed in for weaker a day today too, and what stocks would you recommend?
Good morning, Aisha. See, since Nifty has broken the key support of 11,750, so I believe that this time it can even break its 50-day moving average, and it can go down and test its 100-day moving average, which is paying near to 11,450. So even from current levels, I think you can see almost 200 to 250 points correction on Nifty. And I think metal sector is clearly looking weak. I think metal index has broken the key support of 2,900 on the charts. So I would like to go with the Hindalco, because here the stock was facing resistance near to 200 mark for quite some time, and since yesterday it broke the key support of 194. I believe that stock can go down further and it can test its previous low, which is 187. So take a short call here. Stop loss should be around 197. And second is a sell call on PEL, where stock has been making lot of lower bottoms. I think it was taking support near to 2025 I think for last 15 trading sessions, but again yesterday it broke the key support of 2025. So I think now it can go down and it can test its October low of 1800. For very short term, I think target would be around 1900. So take a short call here. Stop loss should be around 2051.
Okay, so those are some picks coming in from Kunal and from Manas this morning on in terms of what they're tracking going forward, and I think we have Manav as well. So Manav, let's get in your strategies.
Yes, my first call is sell on Jubilant Food. The prices after a sideways consolidation has witnessed a breakdown on its daily charts and is trading below its both long-term averages. In fact, this breakdown has also accompanied by above average volumes and increase in open interest, which suggests there could be a strong momentum on the downside going forward, and the oscillators are still in a negative zone. I feel on the upside 1300 is a strong resistance, which could be a stop loss for a sell, and we maintain our lower targets of 1220. My second call would be a sell on KTK Bank. In fact, the stock has seen a breakdown from its rising flag pattern, and usually such formation breakdown are continuation of its downtrend move. The overall trend for KTK has been on the lower side since the prices are still forming a series of lower tops and bottoms, and we expect the stock to breach its recent swing low and eventually trade much lower, and has still more potential on the lower side. We recommend a sell into KTK with a stop loss of 108 for lower targets of 100.
Thanks for that, Manav. Let's also go across to Ajay now. He's standing by with a look at what CLSA is saying on those refiners. What's the outlook there, particularly with what we've seen on crude? Ajay?
Very differentiated note which CLSA have actually come out today saying that oil refining stocks in India are something to be watched out for the downside, because the kind of oil price fall which we are seeing and the refining stocks going higher, it may not sustain. They believe that this oil fall is actually very different to the 2000, the earlier ones in 1997 and 3-4 times the last 25 years, because this is coming on the global demand slowdown, and when that kind of a fall in oil prices actually come, refining margins actually go down as well. So the cheer in oil stocks, oil refining stocks, that the crude is falling, margin will actually rise, may be short-lived. In fact, we have seen earlier JP Morgan also say that refining margins of Reliance Industries that may come under pressure. So if that is the case, then this entire basket may be on the downside, and Reliance being the big one could weigh on the markets as well.
Okay, that's the word coming in on refiners by CLSA. But Vivek, what does Goldman have to say about ITC and Avenue Supermart?
Well, after a long time, you're actually seeing Goldman Sachs, or in fact any brokerage company, actually getting quite bullish as far as the prospects of a particular company are going. In fact, ITC, a lot of the companies, there's been a lot of negativity around ITC itself, given the fact that some amount of tax price increase or any kind of regulatory action could be taken as far as the tax prices of cigarettes are concerned. However, what Goldman Sachs is saying is that number one, they've actually upgraded ITC to a buy, and their target price is almost 315 rupees a share. What they're actually calling ITC is they're calling it a blue chip, which is currently available at a discount. They've also written about the price hikes, the marginal price hikes that the company has taken. Yesterday, some of the agencies reported that company has increased prices for Benson and Hedges in certain categories. Also, what they're saying is that the company that had accelerated a lot of capex investments in some of the other businesses at this point of time, that should come to a close, and they believe that you're going to see better profitability from the other businesses going forward. They're also saying when you're comparing ITC to the entire consumer pack, the valuations are less demanding and in fact quite attractive. So, and if you talk about Avenue Supermarket, what Goldman is saying is that they maintain their buy stance. They're actually added Avenue Supermarket to their conviction list. They believe that given the fact that the company has underperformed the entire coverage group by almost 22% on a YTD basis, they believe at this point of time valuation as well as the price gives them very, very attractive point. They are very bullish as far as the long-term prospects of DMart is concerned, and which is why today ITC as well as DMart is on Goldman's shopping list.
Thank you for that, Vivek. Okay, let's take a very quick break now. When we come back, we'll have a lot more lined up for you. We'll have more big voices. We'll also, of course, continue to get a check on really the implications, for instance, of the move with regards to that HDFC, AMC and the fixed maturity plan. All that and more coming up. To stay tuned.
Hello, thank you for staying with us. As we walk into this morning, don't get excited about that FDIF buy figure. Yes, DIs were large buyers in the cash market yesterday, but that was only because of the Shri Ram transport deal. You strip that out, you can't get the absolute number, but if you strip that out, the number may not look all that impressive. In fact, the biggest irony for our markets is that right now the list of what could go wrong is a pretty long one. Globally, it's about trade war. Locally, it is slowdown. What will happen to Yes Bank? How DHFL saga will continue or move? And what is the future for some of the NBFCs which up until now have been borrowing from the wholesale market and lending in the retail market? That is the picture, or that is the liquidity picture, which just tells you that after that bumper March, when we got record inflows, the month of June has been quiet. Devang Mehta, 23rd of May, when Prime Minister Modi got re-elected, everyone thought that India's moment in the sun had arrived. The bulls were thumping the table with the view that a stable mandate means good news for the market, and the market should go higher, and the markets will go higher, and markets will not correct. But look at what's happening.
Good morning, Nikunj. Thanks for having me on the show. I think yes, clearly after 23rd the sentiment had turned I can say quite positive, but what has played out after that, one after one, the accidents which were happening earlier are not finding any, I can say, a conclusion which is positive for the market. So right from, as you were rightly mentioning about starting from ILNFS to DHFL to the Yes Bank saga to in fact even Jet Airways, I can say that there are so many accidents happening even within the Nifty stocks that you go outside and look at what's happening to mid caps and small caps. The consensus trade after the election results, after the thumping victory that the government got, I think the clear mandate was to buy mid caps and small caps, which has not played out. In fact, if you look at the last 1 month trade, a lot of mid caps and small caps, in fact, because of the prevailing liquidity situation and whatever the FIs want to put in money, of course we have seen not great inflows, but whatever they want to buy market leaders, or they want to buy something among the top 5 or 10 stocks, which probably has been the story in the last 1.5 years, and that has continued even after elections. So now what we are seeing is again a polarized market, mid and small caps probably not going up. Now people expecting something from the monsoon, people also expecting that government would come up with stimulus in the form of consumption boost for the budget. There would be something which would be put in the hands of the consumer, something in the hands of the farmer, how they would find a solution to the NBFC crisis. I think all these are questions which are unanswered. So yes, markets are temporarily experiencing sort of a jolt in the wake of no good news. Trade war also, as you rightly said, is also an impending issue with India. But yes, one thing that crude probably trading around 60 is a bit of positive, and the next 5 years we have a stable government in place. It's again a positive. So my sense is yes, this can be a correction which can still last for 3-4% more. But yes, you have to find your opportunities in this type of correction.
We are addressing the entire HDFC AMC move where they have decided to use their own balance sheet to give liquidity to some of the unit holders of FMP. Dhirendra Kumar, this is unprecedented. Good morning firstly, Dhirendra. But this is unprecedented. If I'm a unit holder, I would say HDFC AMC is a messiah and they're using the old balance sheet to bail me out. But if I'm a shareholder of HDFC AMC, I'm going to ask a question which is that, look, I did not sign up for this.
No, not really, one, that it is not unprecedented. There has been similar instances in the past where AMC had to take it on its books. And yes, this is significant because this is likely to be a contingent, slap of nearly 500 crore. But it is not, there are two ways of looking at it. One is that if HDFC is able to do, one is the legal issue around it, that they might be under regulatory pressure that why did you do this collateral lending? Are you permitted? Or, it could get into a regulatory issue. A regulator might be asking that were you within your rights to do this kind of lending? That's one issue. The other is that the AMC decided not to exercise its right to sell the shares, which could be to the disadvantage. So that is another thing which regulators might ask. Second is that, as a result of this, HDFC might, lose half its annual profit or, 2/3 of its profits. But at the same time, they will be able to build a moat around it, because this is something which no other AMC can do. No other AMC can do, or a few other AMC can do. And that apart, this is mutual fund is a reputation business. So if you have to take such a thing on the way, it's okay.
2008 also, I remember when it comes to the Subiksha case, some AMCs did bail, investors out. But is this the right way, Dhirendra, for an AMC? I mean, if I'm a unit holder, I would say, look, I have got protected because I've invested with HDFC. But you don't know where this entire NBFC crisis would move. This is not the end of the problem. This could be a prolonged issue which could, just prolong for another couple of quarters.
Yeah, this is something which can actually open a can of worms. Principally, I agree that mutual fund is a pass-through. All the profits and all the losses should be transferred, should be investors. It can't be a situation that profit is investors and losses will be AMC. But this is something, as I was telling you, that the regulatory framework, whether they were permitted, did they exercise diligence in selling the securities, or At the same time, these are the kind of liabilities. If it turns out to be a 20,000 crore position, how will an AMC do? So you never know what could be the scale of it. Yes, HDFC AMC in its wisdom and given the circumstances has chosen to do this, which might be good, which might be disadvantageous to the AMC in the short run, but I think in the long run it will benefit them. This is definitely setting a wrong precedent. Bad credit it should be all investors. A mutual fund is a pass-through. It might be setting a wrong precedent.
So much for taking our time and speaking with us this morning. Investors did want to hear out from you. In fact, let's take that discussion forward. Pankaj joins in with a note that Morgan Stanley has written on HDFC AMC. Pankaj, how are they taking to the news?
So they have not done any major changes to their target price at this point of time. Yes, they have given an update regarding this particular news flow by saying that they maintain their overweight, and this is something which they want to track. They have not commented on it by saying whether the investors will take it on a bad way or in a good way, but probably just looking at the overall thing, they maintain their target price of 2,000. That's in and around where the target price, that's in and around where the current market price is, and probably they are saying that this is something which should not be taken as a precedent going ahead. That every time this happens, this will happen. That's one statement probably which they are telling their view, that this should be treated as a one-off. But let's wait and watch, because they have not given a decisive EPS cut or an upgrade on the basis of this news flow.
All right, thanks so much for that, Pankaj. That's the big news we're tracking for you this morning as well. So an overweight coming in from Morgan Stanley on the same. We've also got a few stocks in focus this morning. Remember, yesterday it was quite a heavy day when it came to some of those metal counters. Quite a rout that we saw across the board there. In particular, JSW Steel, that's one that we were looking at with the kind of cut that it saw in trade. And on the other hand, of course, the one odd stock that actually stood out in trade was perhaps an Apollo Tyres. Some element of a block deal which you don't have too many details on, but perhaps that's what led to that surge in the stock when it was one of the few that was actually moving. But JSW really seeing a bit of a knock, and not the only one across the board, in fact, in the metals stack.
Devang, do you track JSW Steel? I mean, for the longest time, bulls have defended this one by saying that, look, this is a converter, and if you buy a converter, you don't run the risk of commodity cycle.
In fact, yes, it's been one stock which has sort of always not followed the trend rather. So the sense here is that probably the times are now such that globally also there is a big slowdown which everybody is facing, and while we talk about rate cuts, which is good for the liquidity situation for us, but overall if you see through the slowdown, I think it's very difficult for such cyclicals per se metals to do very well. So if you look at a lot of numbers of say Tata Steel or even other metal counters, I think it's going to be increasingly difficult to justify how they would sort of go up from here, valuations, and of course if valuations don't go up, even the price points would be difficult to go up. So my sense is yes, JSW can probably defy the trend for some time, but we wouldn't like to touch metal counters at this point, looking at the global volatility. A lot of domestic centric plays are getting inexpensive by the day, and probably if there is a correction which we experience in the next, I can say 1 month or 2 months, there are a lot of domestic centric stories which would appeal to us rather than anything which is more global or where we don't have the wherewithal to understand it in a sort of a sound manner.
Apollo Tyres. Now Apollo Tyres, we are talking at a time when we know there is a painful and a visible slowdown in the auto sales. Auto sector is slowing down. Everyone in a sense is feeling the heat. The last 1 year Apollo Tyres has taken a knock of about 26%. If you compare Apollo Tyres with, let's say, Seat, or for that matter if you compare Apollo Tyres with an MRF, the fact that they've had the global exposure, which sometimes has been, which in a good global growth environment has worked for them, but in a very choppy global environment, I think that whole thing has been painful for them. MRF has done 26% in the last 52 weeks. Seat is on 28%, and Apollo Tyres also done 26%. So the thing with tire stocks is that even though they try to differentiate themselves, market hardly differentiates themselves when it comes to the price action. Devang, tire stocks, if somebody buys them, should one focus on the bad news coming from autos or good news coming from crude and good news coming from the raw material side?
I think here is a time where you are seeing auto stocks getting hammered. Auto ancillary, of course, is a story which depends upon the auto, and it's sort of played as a proxy when you see that the auto sector is doing well. My sense here is, why not take direct exposure to auto stocks which have seen huge correction? Just not recommending, but just giving examples for companies like Maruti, for companies like Eicher. The world's not coming to an end. Of course, I know there are problems, and the statement would look a little more superficial in the prevailing slowdown where we have seen the last 6, 7, 8 months of big demand slowdown, and 1 quarter more can probably be a little bit of a extended slowdown. But my sense is a company like Maruti or a company like Eicher who own market share in the respective sort of segmentation, I can say that why not buy this when they are getting inexpensive by the day. Of course, there will be time when auto ancillaries would also play out to be larger stories, but a lot of these tire companies, as you rightly said, are also dependent upon the global demand. Of course, the OEM demand has been slack. The replacement demand probably does not slow down big time. But my sense is, yes, to answer your question, first we would buy the auto stocks for a couple of years horizon, and then something in the auto ancillary. Yes, couple of tire stocks will look good here also. Even some auto components which have seen huge correction, companies like Endurance Technologies also look quite sound for a 2-3 year horizon.
My heartiest congratulations to ET Now on completing the big 10th anniversary. Over the years, ET Now has built up a formidable reputation to bringing only the latest business news, but also in-depth analysis, and with a very strong list of reporters. So best wishes going onwards, and we all enjoy watching ET Now on a regular basis.
Celebrating our 10th anniversary here on ET Now this week. Let's also now focus on some of the top 5 stocks you should have on your radar as we head into trade today. We're looking at Jet. Remember, lenders have now dragged Jet to the insolvency court, and we brought this news to you first right here on ET Now late yesterday afternoon, and it seems to be the final sort of hammer in the coffin for Jet. Meanwhile, HDFC AMC, and we've been discussing this in detail this morning as well, they're going to be absorbing about 500 crores of SL exposure on their books, on the back of that fixed maturity plan. We've got Goldman Sachs upgrading ITC to a buy. We've also got DMart in Goldman's conviction list. So those are 2 significant moves there on Goldman's end. And Tech Mahindra is looking to buy Canadian firm Objectwise Consulting. So keep an eye out on TechM as well to see if it reacts to that news coming in. So those are some of the stocks on our radar. We're also discussing some strategies with our technical experts, and while markets have been looking a little down and a lot of sell calls coming in, let's see if there's anything else catching their eye. Manas, let me come to you first in terms of broader markets, mid caps, what will you be suggesting today?
I would like to go with the Petronet, and that is a sell call, because I think just 2 weeks back Petronet made a bearish engulfing pattern on the weekly chart, and we have seen a lot of selling pressure in last 2 weeks time. Yesterday it broke its 200-day moving average also on the downside, so I believe that stock can go down further and it can test 220, 218 levels. So take a short call here. Stop loss should be around 234.
Okay, Manav, what about you? What would you suggest?
See, at the current levels, looking at the mid-cap space, definitely there is going to be a good sell-off going to see, and so I have a sell on India Cements. In fact, the prices after a short-term consolidation has seen a breakdown, and overall the weekly chart also looks quite weak. The momentum oscillators did also witness a move on the downside, which is indicating further lower lows for the stock going forward, and the open interest has also considerably increased. So at the current zone, the stock will witness series of resistance at 94. We recommend a sell into this for the stop loss of 95 for low targets of 88.
Okay, and Kunal, let's quickly get some of your strategies.
It's a buy on Hexaware. I believe that stock is more of a stable stock. Last 2 days we've seen good volume patterns for the stock price, and I think the good thing about the chart patterns is now nearing a break above its 200-day moving average. So on the back of some steady volumes, good price action, and now while breaking the 200 moving average could be a good decisive indicator of a trend reversal for Hexaware. Hence a buy with a target of 366 and stop loss to be kept at 349.
Okay, look at some of the top headlines when it comes to the Economic Times this morning. Let's pull up what's hot off the press. Deloitte now meeting government officials amid that possible ban. That situation heating up there for Deloitte and the global CEO here to meet government officials to try and douse that fire. Asset Group in talks to sell solar assets and it's a wellness center in the US. Remember, they are looking at paying off creditors and this is ongoing in their strategy to really continue to deleverage. And the government planning a company to screen and rate borrower to form a database. That's what they're looking at. So as of now, more of a proposal that's come out to track loans, to track, really what borrowers are looking at. Part of one of the initiatives by the NDA government there to impose stricter reporting norms.
Monitoring the markets, and if I just look at the list of losers yesterday, it was the usual suspects. Jet Airways, before it gets ousted from FNO, that was down about 33.7% in the futures. Yes, you heard me right. PC Jewelers lost about 18.5%, and then Diwan Housing, which was down roughly about 10% as well in yesterday's session. And Kunal, you've been warning investors of a weak bias in Diwan Housing. Do you sense the stock could fall further from the 70 rupees level that it closed at yesterday?
So the only point which I would want to add with the other view on Diwan Housing is that it may not form a bottom in the short span of time. Such kind of heavy selling pressure which you see into a stock price going into the thick of the news flows, it takes out money or it erodes money for a lot of short-term traders as well as investors. Those stocks are generally used as more of trading opportunities, and rallies of 5%, 10% when you see that coming into these stock prices, it's generally taken as a shorting opportunity or an opportunity to either exit your longs at slightly better price than what was maybe yesterday. So I believe that's going to be largely the trend for Diwan Housing, and to try and time these stocks and anticipate a bottom formation could probably be a futile process. So I strongly believe that Diwan Housing could drag lower from current levels, and I think there should not be an anticipation to try and bottom fish over here.
Okay, let's also welcome on board then Deven Choksi. Deven, hi, good morning. Just going through the news of HDFC AMC, which is now going to provide some liquidity with regards to exposure to the SL group. It's a sizable sum, 500 crore rupees. Do you think this is not going to go down well with shareholders today?
Yeah, good morning. On one side, I think this should be seen as a credibility enhancement measure towards the fund investor. On the other side, I think to the shareholders, I think this is definitely, going to be a little bit suspected. However, the long-term view, if the shareholders are taking in this particular case, then it should be that I think if the credibility is kept intact, then in such situation, I think the fund would be in a better position to attract the additional fund flows going forward. So yes, I think it's a situation wherein on one side you have to manage the shareholders and their expectations. On the other side, I think you have to manage the unit holder and their expectations. I think they at this point of time lean more towards the customers, that is unit holders, and I think the shareholders have been probably little bit on the negative side, if I may want to call it, at least in the near term. Maybe the long-term impact will be positive of this particular move. So certainly nothing to add further on the shareholder side, I think, as far as activity goes. But yes, it is going to give a long, I would say, support to the unit holders, investors, and I think that should result a little bit favorably as far as I think the market sentiment is concerned.
Devan, if you are a HDFC AMC shareholder, is it ouch moment? What has HDFC AMC done? How come they are using their own capital to bail out FMP or unit holders?
Nikon, it is happening. I think it is happening for the first time, at least as far as we are concerned. And I think this particular move will have to be seen in the light of, as I explained, over a longer period of time, it could probably lend better amount of stability to the company, the AMC per se. Whether immediately the impact would be negative, yes, I think immediately the impact would be seen little negative. And whether one would like to get out of it, I think the investor's individual call. I would not be able to give it this call at this point of time.
interesting report coming out from CLSA this morning with, sell calls coming in on those refiners. I just want to get your perspective as well. He's saying that the fears about the global slowdown will have a huge impact. It's a negative for margin, the demand-led slowdown. What's your sense? What would you advise at this point of time on some of those names?
I think you mentioned DHFL.
Refiners, they win this morning. OMCs.
Sorry. No, I think the refiners, I maintain my view. I think I am not changing the view at this point of time, because I think the crude oil volatility is something which is not very easily understood, at least at this juncture. But at the same time, I think the ability to basically meet the kind of a GRM pressures in given kind of a situation, I think would be tough, because I think Reliance probably has been successful relatively, in beating the GRM pressures and creating the alpha over Singapore GRM. I'm not typically very sure about the OMCs as far as their ability to meet the GRM pressure in the given situation. So frankly, I think my view is that at this point of time, we don't hold any kind of a buy on the OMC companies. We probably stay invested with Reliance, where we have relatively larger conviction about the refining business.
Let's to go for the first pre-open rates to come, and we are minutes away from the pre-open rates. I mean, this is one of those markets where frankly I don't think anybody is anticipating anything large. It's a market where you are in the slow grind on a daily basis. A lot of mind space of this market. Globally everybody is worried about trade war. So every second person you will ask, you will quiz, you will call for a market view, they would tell you, look, everything is looking great, but we are worried about trade war. Similarly, locally, anybody you will call, quiz, ask, the answer which comes back is, look, NBFCs are in a mess and we are worried. So this entire NBFC, where Diwan Housing, Indiabulls, future of Yes Bank, what will happen to some smaller NBFCs, it is occupying so much of mind space that nobody is in a mood to really commit. The valuations for good companies are not that great that you want to go against the crowd. Those who've gone against the crowd in mid and small cap stocks, they've got cleaned out. I guess somewhere capital erosion is something which is really forcing the market and participants to stay on the sidelines. Whatever cash people have, they are not investing. The sensible guys have already invested and they are losing money. So when on a daily basis you see a portfolio going down, it's a very annoying feeling, and I think we are really trapped in that kind of an market mess right now, where prices are not appreciating. Nifty is where the action is. 8-10 stocks are just moving here and there, and they're just forcing HNI investors to rethink their portfolio allocation. Then what will scare the bears? I mean, right now this market is in a bear grip, so to speak. If I take Nifty out of the definition, this market is a very hollow market.
Absolutely right, Nikunj. I think even Nifty too, I think if you look at 10-12 stocks in the Nifty, they are the ones who are basically managing the levels of Nifty, I would say so. And beyond that, I think you are not seeing much of an action even in Nifty stocks, or even for that matter, I think the mid-cap, small-cap stocks, as you were mentioning, I think it's a complete wipe-off as far as the portfolio is concerned. I think there are a variety of reasons as I see it. I think one of the important aspects is the financial sector. The stress in the financial sector is unnerving. Actually, I think sooner it is arrested, better it would be. Otherwise, I think it could have a domino effect on respective other sectors also. Currently, I think the situation demands that some of the assets which are turning bad or are bad assets, I think they could be possibly parked in a separate vehicle like Suti that at one point of time the government of India thought of in 90s when they bailed out Unit Trust of India's 64 scheme. I guess this is something similar which is happening on a much larger scale though, wherein some of the stress assets called bad assets will have to be parked into some of the stress asset funds or the company which we want to call it as, want to call this a bad bank, but the fact is that you need to create this kind of a support system. If you do, then in such situation at least you will save the domino effect coming on to the respective other places. The important aspect is that today if NBFC and banks are more busy collecting their money and less focus on lending the funds, I would think that it is going to ultimately hurt the economy, and whatever the growth level that we are talking about in the economy, or whatever the job creation that we are talking in the economy, may not materialize. So I think it could demand probably I think very serious attention and action from the government side to probably arrest the kind of panic into the financial sector, at least on an ASAP basis.
Those pre-open quotes this morning.